2024 has been a remarkable year for ETFs, with surprising top performers from every corner of the market. Which ETFs are bringing massive returns, and why are they outpacing the competition? Welcome to our roundup of 2024's top performing ETFs. Exchange traded funds, or ETFs, have become a favorite for investors thanks to their easy access to a variety of markets and lower costs compared to other investment options. In 2024, we've seen some impressive performances across different sectors, especially in areas like technology, cryptocurrency, and even commodities like gold. The beauty of ETFs is how they allow you to invest in a bundle of assets, diversifying your money without needing to buy each stock individually. This year, the focus has been on specialized ETFs that tap into high-growth areas and emerging trends, giving investors a chance to benefit from powerful market shifts. Our top picks, backed by sources like US News and Bankrate, represent the ETFs that have consistently outpaced others, delivering impressive returns. Let's dive into what makes these funds standout investments in 2024. Chapter 1. YieldMax NVDA Option Income Strategy ETF, or NVDY. Let's kick things off with one of 2024's most talked about ETFs, the YieldMax NVDA Option Income Strategy ETF, ticker symbol NVDY. This fund has been making waves, delivering a jaw-dropping year-to-date return of 75%. But what's behind this remarkable performance? Unlike most ETFs that simply hold stocks, NVDY takes a different route. It focuses on generating income through options like NVIDIA, one of the biggest names in the semiconductor world. With nearly $1 billion in assets under management, NVDY has drawn in investors looking for high returns, though it's important to note the high risks. The fund operates with a unique strategy that writes or sells options on NVIDIA stock. This approach allows it to generate regular income, which it distributes to shareholders as part of its return. While this can provide solid gains, the strategy comes with potential volatility, especially given NVIDIA's active trading patterns. Another factor to consider is NVDY's expense ratio. At 1.01%, it's on the higher side for ETFs, meaning investors pay $101 per year on every $10,000 invested. However, many are willing to accept this cost in exchange for the income potential it offers. So, who might find NVDY a good fit? If you're an investor drawn to the tech sector and seeking consistent income, but can handle a bit of added risk, this ETF could be worth a closer look. Just remember that, as with all investments, past performance doesn't guarantee future results. Chapter 2. Grayscale Bitcoin Trust, GBTC. Next on our list is the Grayscale Bitcoin Trust, or GBTC, a fund that has drawn substantial attention this year as the world's first publicly traded Bitcoin fund. This ETF has posted impressive returns, with a year-to-date gain of 33.6%. Unlike most ETFs, which hold stocks or bonds, GBTC offers investors exposure to Bitcoin, making it a popular choice in 2024 as digital assets have gained renewed momentum. GBTC doesn't directly hold Bitcoin, but operates as a trust, managing a large reserve of the cryptocurrency and allowing investors to buy shares. This setup gives investors an easy way to gain Bitcoin exposure without having to worry about directly purchasing and storing the digital asset, which can be complex and involves extra security measures. For many, this trust offers a streamlined entry into the world of cryptocurrency. One key consideration is GBTC's expense ratio, which stands at 1.5%, higher than many traditional ETFs. This fee has spurred Grayscale to launch a mini trust this year, which offers Bitcoin exposure at a much lower cost of 0.15%. But despite the higher expense, GBTC's size, currently holding around $13.3 billion in assets, reflects its continued popularity. This fund is best suited for investors with a strong interest in crypto, but who prefer a more traditional investment vehicle than purchasing Bitcoin directly. But remember, crypto markets are highly volatile, so only those with a strong risk tolerance should consider GBTC for their portfolio. Chapter 3. Invesco S&P 500 Momentum ETF, or SPMO. Moving on, we have the Invesco S&P 500 Momentum ETF, or SPMO, which has gained notable traction this year. Posting an impressive 31.8% year-to-date return, SPMO stands out by targeting high-momentum stocks within the S&P 500, focusing on companies showing strong recent performance in the market. This strategy has paid off handsomely in 2024, especially for investors looking to capitalize on large-cap U.S. stocks with growth potential. What makes SPMO unique is its approach to stock selection. Rather than holding the entire S&P 500, this ETF hones in on the top 20% of large-cap stocks in the index that exhibit the best near-term momentum. Right now, its top holdings include major players like NVIDIA, Apple, and Meta platforms, with tech making up over half of the fund. This heavy tech allocation has been advantageous, given the strong performance of tech giants in 2024. With a low expense ratio of 0.13% and assets under management totaling around $2.1 billion, SPMO has attracted investors who want growth without paying high fees. This low-cost structure helps ensure that a larger share of returns goes straight to shareholders. SPMO is best suited for those interested in a high-growth, high-momentum strategy, particularly within the tech-heavy large-cap space. However, given its focused approach, investors should be aware that this ETF may experience greater fluctuations than a broadly diversified fund, especially if momentum in the tech sector shifts. Chapter 4. Van Eck Semiconductor ETF, SMH. Now let's look at the Van Eck Semiconductor ETF, ticker symbol SMH, a powerhouse fund that has continued to shine in 2024 with a year-to-date return of 28.5%. This ETF focuses on the booming semiconductor sector, an industry that's been critical in powering everything from advanced electronics to AI. SMH is an ideal pick for investors who want exposure to a concentrated yet vital part of the tech world. The fund's top holdings include semiconductor heavyweights like NVIDIA, Taiwan Semiconductor Manufacturing or TSMC, and Broadcom. These companies have delivered significant gains this year, with NVIDIA alone seeing returns over 100%. With roughly 25 holdings, SMH is more focused than other tech ETFs, meaning its performance is closely tied to the health of the semiconductor industry. This focus on semiconductors has allowed SMH to capitalize on high demands for chips and the advancements driving the industry. Another attractive feature is its moderate expense ratio of 0.35%, combined with its substantial assets under management, which total $22.4 billion. This balance of cost-effectiveness and substantial AUM makes it a popular choice for investors looking for reliable tech exposure. SMH is well-suited for investors with a specific interest in semiconductors and a long-term perspective on the industry's growth. However, given the concentrated nature of the fund, it's worth noting that SMH can be more volatile than a diversified tech ETF, especially if the semiconductor market experiences any downturns. Chapter 5. iShares MSCI Global Gold Miners ETF, or RING. Switching gears from tech, we have the iShares MSCI Global Gold Miners ETF, ticker symbol RING. This ETF has been a solid performer in 2024, delivering a year-to-date return of 26.3%, largely due to the strong rise in gold prices. With gold up around 20% this year, RING offers investors a way to benefit from precious metals without directly holding physical gold. RING focuses on a range of gold mining companies across the globe, including major players like Newmont, Agnico Eagle Mines, and Barrick Gold. These companies have benefited as investors turn to gold for its defensive value, especially during periods of market volatility. RING's strategy of investing in global miners means it doesn't rely solely on US markets. Instead, it diversifies with significant holdings in Canadian and South African firms. The ETF's expense ratio is relatively low at 0.39%, and it manages a substantial $567 million in assets. For those seeking some exposure to commodities and looking to diversify outside of stocks and bonds, RING offers an accessible option. This ETF is best suited for investors wanting indirect exposure to gold and for those looking to hedge against market uncertainty. As always, keep in mind that mining stocks can be volatile, particularly as commodity prices fluctuate. Chapter 6: Invesco S&P Midcap Momentum ETF, or XMMO. Finally, let's explore the Invesco S&P Midcap Momentum ETF, or XMMO. This ETF has shown strong performance in 2024, with a year-to-date return of 26.2%. Unlike many funds focused on large-cap giants, XMMO targets mid-sized companies with high momentum, those that are trending upward and showing strong potential within the S&P Midcap 400 index. The ETF uses a unique approach to narrow down its holdings. It selects the top 20% of midcap stocks based on their recent momentum scores, creating a portfolio that's lean and focused. Currently, the fund is heavily weighted in industrials, making up about 40% of its holdings, with additional exposure to tech and consumer sectors. This focus on midcaps gives XMMO a distinct edge, allowing it to capture opportunities among companies that may not have hit the radar of large-cap focused funds. With a moderate expense ratio of 0.34% and $3.1 billion in assets under management, XMMO is an appealing option for those looking to tap into high-growth mid-sized companies without the higher costs seen in some other specialized funds. This ETF is ideal for investors seeking growth opportunities in mid-cap stocks with a momentum factor. However, as a momentum-driven fund, XMMO can be volatile, especially if trends shift quickly in the mid-cap space. So, there you have it, 6 of the top-performing ETFs that have led the charge in 2024. When considering any of these ETFs, remember that performance alone isn't the whole picture. Each fund brings its own level of risk, expense, and exposure to specific sectors, so it's essential to align your choices with your personal financial goals and risk tolerance. Diversification across various types of funds can also help protect your portfolio, especially during uncertain times. If one or more of these ETFs caught your interest, consider diving deeper, researching further, or consulting a financial advisor to see how they might fit into your portfolio. As always, stay informed and make investment choices that support your long-term financial goals. Thanks for watching, and we'll see you in the next video.